Carl, when we were on the phone the other day, you told me you'd lost money in this coronavirus recession and sell-off. And I thought to myself, how's that possible? This is Carl Icahn, but not everybody is completely infallible. Tell me what's been going on with you, with your portfolio over the past 7 to 8 weeks.
Yeah, well, we keep it pretty well hedged, and but even the hedges couldn't stop us from losing some money, but we still have quite a bit. So I'm not crying about it, and we have, as I've always kept, a large amount of cash or cash equivalents for a stormy day. So I think there's going to be very interesting times ahead. And while you have to be extremely careful in this market, and we can discuss that, I think there will be also some good opportunities. But I can't talk about it short term. In the short term, I think you may have some big downdrafts. So that's where I am with that.
You've given me a couple of provocative openings there. Let's start with the last one, big downdrafts. Do you think, Carl, that we've seen the bottom put in on March the 23rd, or could we test or possibly even go through those lows?
Well, if you could tell me what the virus is going to do, when people start going back out, and I tell you that I don't think it's going to be as good as some people think.
You mean the recovery?
The optimism that it's not like turning on a spigot. So I think you may see recurrence of that virus. Several years ago I donated the hospital, or at least I gave enough money to have my name on it. It's Icahn Medical School at Mount Sinai. So I have the honor of being able to. I don't micromanage it at all, but speaking to some of the really smartest guys in this area, and there is concern that it's not going to be, just let's go out and let's go have fun. I think this virus is the most contagious one that I think they've ever seen. To give you a comparison, in SARS, one person would infect 1.2 people. Here, you infect 5 people because you infect people even if you're asymptomatic. So, I'm not going to get into that. That's not what you need me on for. But I don't think it's. I think this thing is going to be in spurts. But I do think eventually it's a great country, and with a lot of different misgivings I have, I think that you will see some great opportunities ahead. But mostly, I think, rather than in these technology stocks and high multiple stocks, I think they're going to be more in the Graham and Dodd type stocks.
The real economy,
I look at
so to
risk reward, so that's basically it.
Carl, given what you've just said, which I wouldn't call pessimistic, I would call cautious, maybe, careful.
Yeah.
You look at the S&P 500 right now. The S&P 500 is at 2825, and if you look at what that's based on, it suggests a 17 times multiple on earnings of $165 next year. Does any of that make sense to you? Given the uncertainty around the outlook, can anybody possibly forecast what earnings are going to be? And even if you could, is 17 times the right multiple?
No, I agree with you. I think you could not really justify that multiple at this time in many of the companies. I mean, these technology companies that have these great multiples, I think the real problem there is that that a lot of that, I think, in many businesses is not needed as much as they sell you. I mean, we have this company Hertz, and I'm not going to go into that. We're on the board and all. But, we spend over $1 billion, not us, but before we got in there. Management just goes in and you spend over $1 billion, and we really don't get that much for it. I mean, it used to be at home. Take your home. You used to go and you put the light. You had a switch. You put the light on. You turn it off. It was nice. And sometimes, okay, it was great because you could maybe make the light less bright or more bright. Now you have all these scenes they put in and all that stuff. So that's just a microcosm of what these tech companies sell you. Now you do need the cloud and all that, but I really think that all that stuff and all that software and all those software companies, I mean, the multiples they have, I don't believe are justified. But that's me, you know. Hey, look, I've.
Are you short, Carl? Are you
my
short Amazon,
biggest,
or are you
yeah.
short? Are you short Netflix,
Yeah, no,
for example?
I'm not. I'm really not short Amazon or those. But I have a hedge on with the S&P and what have you. But my biggest position, Eric, my biggest position today is a short sale in a way, and that's in the CMBX sixes, where I mean, I look at risk reward, and I never, and I started shorting this last summer, way before the virus
just to
came on.
Just to be clear, what we're talking about, you have a short position on the CMBX, which is an index of commercial real estate debt. I got that straight.
Exactly.
Correct? Okay, and you're using,
yes, you got,
and the way
to
short that, if I understand it correctly, is to use a credit default swap.
Yeah, so it gets real complicated, but basically, these people that invest in funds, it's almost '08 all over again. It's the little guy and the people that just come in, and they get sold a bill of goods, and it's sort of a sad commentary. And hey, look, I'm in the business to make money, and I don't deny that, but it sort of outrages you to see some of the stuff that they're selling now. In this one, the CMBX and the funds that have the biggest position in it. Hey, look, and they know I'm short, and they wrote about me, so I can tell you it's Putnam and AllianceBernstein have these very large positions, and they put people in them, and what they really are doing are selling. These people are really selling insurance.
They've sold you an insurance policy, in other words.
Yeah, they're really selling. I don't think the people understand it. I mean, these derivatives are a PhD in business wouldn't understand what these derivatives are telling you and what they're doing. But we're on the other side of it. In other words, we buy the insurance. And Putnam and AllianceBernstein, for instance, tell their investors that their investments should, I'm sort of quoting them, should be compared to treasuries, meaning that they're very safe, right? But it's completely misleading. It's disingenuous. A good part of their investments are in these complex derivatives. I mean, it would take a PhD to decipher them. And basically, these derivatives, like we said, are insurance policies on triple Bs and double B bonds that are in that CMBX index. Now, to explain it would be hard to do, but it's just simply what happened to AIG in '08. So these small investors are putting money into these funds, and by the way, they pay Putnam 4% just to get into the fund. And what's happening is they could lose. And they don't understand that they could lose 80 to 100% of their money when they put money into that Putnam, into those diversified funds.
So just to get this straight, they've bought into these. You say that Putnam and AllianceBernstein sold retail investors, the little guys, so to speak, a yieldy vehicle, offering them some high mid single digit yield, 6-7%, better than treasuries, better than corporate bonds maybe, and they could stand to lose a lot of money if the commercial real estate market falls apart, and it is falling apart. So I've seen the indexes. I've seen where they're trading. I know that the CMBX triple B is down to 65 or 67 cents, and the double B is down into the 40s. That suggests to me, Carl, given that you said you bought in, you put this trade on last summer, you made a lot of money.
Yeah, we're doing quite well in it. I mean, and we
what does quite well mean?
Well, we started in the summer, but we added to it. But I mean, it was a ridiculous trade in the summertime because you're taking this inordinate risk and it's the same damn thing as '08, where actually, but in 08 at least, AIG should have been cognizant of the risk they were taking. Here they're putting people into it. And so, it bothers you that it sounds corny, but you get outraged by what they write. They tell everybody, oh, it's similar to Treasury bonds, or you compare us to Treasuries. So, in other words, you get the guy who say, well, look, I could get you 6%.
Carl,
it's complicated. It's 3%, and then
it is so complicated that it's probably not worth getting in. It's probably not worth getting into too much more of the mechanics. But I would like to know, if you don't mind, can you give us a sense of how big this position is and how much you've made on it over the course of holding it and adding to it over that period?
Yeah, look, I'm not going to get into. We have billions and billions of dollars on the short side of this, because it really is a beautiful trade on a risk-reward basis. I was brought up in the old Graham and Dodd philosophy, and you look at risk-reward. That's what I look at. You look at risk-reward, and that's what, as you pointed out before, Eric, the risk-reward in this market isn't the greatest right now. The risk is too high for the reward in many, many companies. But here, I've never seen anything where the risk-reward was so bad, because here you could risk. When you sell this thing, as AIG learned, and you would think a lesson should be learned and you shouldn't be pushing this stuff, you could lose really all of your money. I mean, now I don't think an investor is going to lose all their money doing this insurance through Putnam or through AI Alliance, but you could lose 80% of it, 70% of it, and indeed, you've already lost about 30 or 40%. And people don't realize it. They go out and tell you, oh, you're getting 6%, 7%, compare it to Treasuries because you buy an investment grade, because that CDS, for some reason, is investment grade. I think now it's lost the investment grade rating. So they're pushing that on that basis, and I really think it's unconscionable. But I'm not going to be sanctimonious. I mean, look, I look for these things.
Of course.
Where
so
I made all my money
is
looking for that risk-reward thing.
I want to talk a little bit more about those risk-reward calculations, where else you've found opportunities to make money in this kind of an environment, which admittedly isn't that easy. I gather you bought some oil on Monday. I want you to tell me about that.
Oh, yeah, well, but that's a much smaller it's a much smaller item. When oil went down to we own a refinery. We own what I think is a very good refinery, CVR it's called, and we own 70% of it. And when oil started sinking like that, I called them up. Usually I don't micromanage or get involved, but I call them up and say, hey, we got some storage space. Everybody's going crazy for storage space. And they said, yeah, but it's hard for us to get the trade through and whatever. But I will say they did a great job, because they set it up real quickly, and we set up an account. And believe it or not, I mean, you never see this. And we made some money on it, but relatively speaking, it's nothing like the CMBX or something like that we're making money on. But it was really fascinating. You'll never see that again in history, I don't believe, where they have to pay you. They have to pay you to take their oil, which was up to $35 a barrel. I mean, it was just an interesting point in history, because again, you got to look at risk reward. And sometimes when you do those futures, and they have funds that do the futures, and the same darn thing again as you had in 08 or in any of these times before the market really breaks. And playing in the future market in the oil game, or in any commodity for that matter, is not for the faint of heart. And it's really not for people
certainly not on a day like Monday.
Don't have a lot of capital to. What's that?
Certainly not on a day like Monday. It's not for the faint of heart. Carl, CVR, your company, between its refineries, has some 6 million barrels of storage capacity. Were you able to fill up all 6 million barrels? How much oil were you able to buy?
I wish we were. I have to tell you, I wish we were set up for it a day or two earlier. No, we only did a small fraction of that. And anyway, we couldn't have done anywhere close to that, because we already had a lot of oil in our storage capacity. But we were lucky that we could make room for 1 million or 2 million, but we never even got that much. But so I'm just saying that it was just an interesting.
I see. So you were able to buy.
We did get a fair amount of it, but I'm not saying I believe it theoretically that opportunity might come again if this market continues. And you know, you mentioned oil, you mentioned these commodities. I mean, those are one of the risks that you face in the future. So if you're looking at this market, I really think that there's going to be great opportunities in some of these very mundane, what I call Graham and Dodd type companies. I mean, you take the refineries, for instance. I mean, they got their problems. You have that political football going on with the RINs, and I think that'll be sooner or later cleared up. I stay out of it now. I don't get involved with Washington in that kind of in any way, shape, or form in that. But if you look at a refinery, for instance, and you look at the value, this is my kind of investment, and what I like doing at Icahn Enterprises. But you don't always win.
Can I ask you
Obviously,
a question about the refineries? Carl, you may have seen, you in fact may know more about this than I do, that Harold Hamm, who owns Continental Resources, declared force majeure on deliveries to a refinery. Was that your refinery, CVR, by any chance?
No, I haven't even followed that. I know Harold a little bit. I haven't. I don't. Yeah, you're telling me something I didn't even know that he called. Well, he didn't want to deliver the oil. Or
Continental
something?
is not delivering on at least one contract because it declares the coronavirus situation and the impact it's had on prices force majeure. Now, I'm sure you can be as cynical as me or anybody else if you like and say, well, that's just the market, right? Negative prices, we've never seen them before, but we've never seen a situation like this before, and that's just the market. Do you think it's fair to declare force majeure, or should, even under these circumstances, should people have to honor their contracts because you're going to want the people you bought oil
Erik,
from to honor their contracts?
Yeah, you're getting me into an area that I don't even know. I don't know the situation. I don't know the facts. So I don't want to get into that discussion without understanding.
That's fair enough.
Facts and
could we stick with oil for just a minute, because as some people are aware, you're exposed to oil in a number of other ways too. You've got a very large position in Occidental Petroleum. You've got a significant position in Tenneco, which I understand relates back to the Federal Mogul sale. You mentioned that you've got CVR. You know, give me a sense, Carl, of if you don't think oil is going negative again, where's it going? And how do you hedge that exposure that you've got?
Well, the short answer is, in stuff like that, you have to have enough capital to withhold against storms. It's extremely hard. I would say in the oil area, it's hard unless you play that future game to hedge it. But we do hedge sometimes against the crack spread. It gets real complicated, where you think the crack spread widens too much, which is the crack spread, which is your diesel and gasoline price against what you pay for the oil, very simplistically. And you can't do it. But the point I'm trying to make is a little different. I'm saying that where I really learned to make money and see it, I'd look for something that sort of hits you over the head, and you say, this is great. And it is hard to find them now. And sometimes you're going to be wrong. But you do find situations where if you look at the whole thing, well, the short of CMBX, I mean, the risk-reward is ridiculous. You take it, if you do it the other way, not the way Putnam is selling it to their accounts. Putnam is telling people, hey, look, I'm getting you 6%. Isn't that wonderful? If you invest it with another fund, you're only getting 2%. So here you got a very limited risk when we did it, when we set it up. A great reward.
Do you see anything else like that in the market right now?
If you're still invested in it, if you're still taking that investment, you really are taking a tremendous risk, and maybe you'll make money. I mean, listen, you take risks. Sometimes, a 10-to-1 shot comes in. But my point to you is the same idea. So you take a refinery, for instance. Now, I'm not selling the refinery here. I'm not telling people to buy refineries, because I think there is so many questions coming up, and so many hurdles coming up on a short-term basis. But if you look long-term, I mean, this is how I look at stuff. You look at, and I'm not only saying refineries, even the oil. if you really look out ahead, there's still going to be a need for gasoline in this country. Now, going ahead 10, 15 years, the electric cars come in, environmentalists are coming in and making you clean up the stuff and possibly refining it. We already got out our refineries. We kept out the sulfur in the diesel. So I'm not going to.
Carl, there are a lot of people. There are a lot of people who would agree that even in the long term, 5, 10, 15 years from now, there's going to be a need for oil. But right now, let's just turn our attention back to the coronavirus and the pandemic. Right now, it is wreaking havoc. I mentioned Occidental Petroleum. The company is so cash-strapped that it's having to pay Warren Buffett in stock, effectively, for the financing deal that you oppose. That must make you boiling mad.
Yeah. Well, listen, and I've said it, and I'm not going to belabor it anymore because the board's changed. We have 3 people on that board. I can't really freely speak about it, so I respectfully disagree a little bit with what you're saying, cash-strapped. In other words, I think Occidental has a lot of great assets there, okay? Being that said, I can't argue with you that it was one of the most ridiculous deals that I've ever seen, and I've said that publicly, but those days are over. We are now on the board. We're working together.
Okay, so you feel...
hopefully, I think that there are things where I think the shareholders will eventually be rewarded there, I think. So the risk reward's in your favor there, I believe. I believe that. However, I'm not here to sell Occidental, and I'm on the board, and I'm not going to go any further.
So let me ask you about...
And by the way, you might be right. I mean, if oil stays bad, and there is risk in all this stuff. I mean, there's no question about it.
Risk, Carl. What about Hertz, for example? Again, a coronavirus situation. Nobody's traveling. Nobody's renting cars. Hertz has hired restructuring advisors. The debt maturities start piling up next year. What's going to happen there?
Well, look, Hertz is different than Occidental. I own a lot of Hertz. I own a lot of Occidental. Hertz, you're more there. People are just not renting cars. Very small amount of renting cars.
Correct.
And you have in Hertz an embedded leverage with the ABS.
You have a half of it. Does that company survive without a restructuring?
Something, because we're on the board, I really can't get into that. Okay, I have confidentiality with the board, so I mean, you read the newspapers and all that, but I cannot really comment on that at this time, Erik. So I'm not going to go into that one.